Well, good afternoon and welcome to today's webinar, Enabling Capital to Bridge $1 trillion SDG gap. And we at CN, as you know, have been thinking about sustainable finance for many years. And in the run-up to COP28, it's a really good time to look at the Sustainable Development Goals and how capital can be used to build a bridge. I'm delighted to welcome Scott Ingham and George Cortales from Matrix Global Services Limited, who'll be our speakers today. You'll know me, I'm Mike Wardle, I'm the CEO here at CN. My job this afternoon is to chair the event, in other words, get out of your way very quickly and leave space for our presentation this afternoon. Just first of all, though, before we get into the meat of it, to say a big thank you to our sponsors, who are, through their generosity, allow us to run these series of webinars and range widely across economics, finance, science, history, and you name it. So we really are very grateful for their support. The program today is quite simple. We have my introduction, very short, then a presentation from Scott and George, which will last about 20 minutes, and we should have 20 minutes or so for questions. For those of you who haven't used the GoToWebinar system before, the way to ask a question is to find the question tab on the dashboard on your screen, type it in, that'll come to us, and we'll field those questions during the Q&A. And you can put a question in at any point during the presentation. The presentation is being recorded today. This enables you to go back and rewatch it if you so wish, or to share the link with your friends and colleagues who may be interested in the subject, and that'll be up on our website in a couple of days' time. Finally, on housekeeping, we will pass on contact details of those of you who ask questions to Scott and George, so if there's any need for follow-up communication, that can be made easy. So that's all from me by way of introduction, but we're going to start with a poll. We would like to ask you a question. It's a very simple one. Would you use structured insurance solutions to support investments? Just give us a quick view as to whether you think you would or wouldn't use structured insurance solutions in investment. Just give a minute for people to vote. And we have the answers. So around 70% say yes, 30% no, which I think sets the scene very well. Scott and George, over to you.
Excellent. Thanks very much, Mike, and thank you to CN for inviting us to do the presentation. I'm, as Mike pointed out, Scott Ingham, the CEO and founder of Matrix Global, and George Cortales is head of our sustainable infrastructure activity. Number of things we're going to cover. Just our sort of headline slide is the Matrix project, which sounds quite grand, but it was very much around a core objective to help structure and create an environment which would enable capital to be deployed more effectively, and to, as part of our activity, contribute to enabling the achievement of a number of the SDG goals. We just go to the next slide. So, at the heart of what Matrix are, we are two things. We are insurance specialists, and we're right at the very specialty end of specialists. And we're also involved in finance in terms of helping to raise capital for projects. And our objective is to put together structures which enable capital to flow in a much more seamless way than it currently does. To join all the threads from the objective investment requirement that's involved all the way through to the providers of that capital at the back, and create something which bridges gaps. We go to the next slide. In terms of our ecosystem, we'll sort of talk about that a little bit more, but the key that we saw was that there was a requirement to change things so that the facilitators of the delivery of capital and insurance didn't continue to operate in what are quite siloed activities. So it's fairly traditional that capital markets and insurance markets talk a different language, and they don't tend to align their solutions. The fundamentals of the way that things are looked at are very similar, but obviously the deployment of the capital operates in a different type of structure. So we're very much trying to converge those two to create the optimum efficiency to enable capital to be deployed. We're going to the next slide. In terms of our overriding activities, at the heart of it, we want to create a positive social and environmental impact. We're very much realists that you have to carry the public and business with you, because there's a lot of conflicting opinions on things. So at the core of it, we're trying to make the things that are not good better, and get more of the really good stuff done faster. And through doing that, then hopefully we can help achieve a number of the objectives under the Sustainable Development Goals. Next slide, please. So, I mean, obviously, everybody, I'm sure, on this webinar will be familiar with the SDG goals. And they're obviously very broad, very ranging, and the organizations and the governments that are involved in supporting these have different focus and capital and objectives. So part of where we sit is that we are looking to create structures that enable not just infrastructure projects to be done, so a water project or a waste to energy or sort of an infrastructure project, but also to use those tools to enable payment systems to be deployed into emerging market territories and to support the funding in those areas, so that we're affecting everything from people at an individual and consumer level all the way through to business. So our activities are very much geared at targeting all of the headlines that are in here and hopefully having an impact in most of them. Next slide, please. Again, I think probably there's so much information published about the numbers around this, and they are getting bigger every day in terms of the requirements of capital that's to be deployed. This is the latest one that we've been using in terms of the breakdown of the average investment needs. Depending on which source you're looking at, we're either overestimating or grossly underestimating what the requirements are going to be, but it's clearly showing across certainly the developing territories particularly that there is significant multiples more of capital needing to be deployed, both government, DFI, multilaterals, and most of all, private capital. So within that structure, we just go to the next slide, just to give you a quick break. I'll let George just cover the SDG capital deployment ecosystem.
Thank you, Scott. As Scott mentioned, the gap is widening. So initially in 2015, the gap was estimated to be $2.5 trillion a year. And the most recent estimates, as per a previous slide, is 4.2 trillion. So capital is not being deployed, despite, if you look at the slide, there is a massive ecosystem ready to deploy capital. And mainly the latest breakdown is 55% of it would need to go into energy, 13% in sanitation, 10% in infrastructure, meaning telecoms and transport, excluding energy, food and agriculture, biodiversity, etc. But this is not happening because financing is about structuring different financial flows, meaning public and private, both domestic and international. And all of these capital sources have different risk expectations and different risk paying thresholds. Can we please go to the next slide? And the global ESG capital or assets under management are expected to reach 53 trillion by 2025, which is 1/3 of all assets under management. So this capital is earmarked going towards projects that we are looking at, projects that help us get closer to the development goals. But as I said, they have different risk appetites, and one of the roles that someone like Matrix does is try to match the risk appetite with the project by using various solutions, insurance policies, financial solutions, etc. Scott will talk about the project we did in Sri Lanka recently and the various elements thereof. Next slide, please.
Great. So as George is saying, obviously there's a large number to be deployed, and part of this is where both the investment institutions sit and also where the insurance market sits, because I think there is a lot of activity, there's a lot of will to achieve things, and the survey results that you're looking at on the screen here are showing that if you survey insurance companies and brokers at a global level, they are very much committed to net zero. They believe in climate action, and is generally being followed reasonably closely in line by the global institutions. I think what we are certainly seeing is that the scale of the commitment is nowhere near to where it needs to be. And a key part of this, I think there's a focus on traditional insurance solutions. I think in terms of the insurers investing, they're concentrating on the improvement of their own organization, which obviously is important, rather than actually looking at the financial engineering solutions that are required to enable the capital to be deployed. And to truly make things happen, that's what we've actually got to do. Next slide, please. So the key in bringing all of this together is to sort of have a nexus around the convergence of all of these areas. So part of the way that we've shaped and organized ourselves is to not be in a silo position, to be horizontally and vertically integrated with our clients, the marketplace, and the types of solutions that we deploy. So we're very much about having knowledge and practical knowledge activity at everything from the development and the origination and the initiation of these projects through to then how that is funded and supported by everybody from venture capital all the way through to ultimately the pension funds for the long-term funding, and then blending that in with the development investors, and working obviously very closely in a number of areas at a country level to support this. So the importance of that convergence obviously is something that everybody's aiming at. But what we are experiencing is that at a global level, there's a very significant split between appetite of insurers and investors, for example, between the US and the Europeans. We had about 60 investor calls with major US investors earlier this year for a variety of reasons. Another key topic should have been about ESG and global sort of just transition for this particular asset, and not a single one of them actually asked any questions about it at all. So I think it's in the box. They're wanting to participate, but the overall commitment and action, both in terms of investment, but also creating insurance solutions and integrating them, is not there. So that's what we're focused on. Next slide, please. So effectively, how we're going about what we're doing is that we'll have a project that will come up, and we'll walk you through a few examples of projects that we've worked on in a few minutes. So somebody wants to do a project. It'll be a project developer, it could be a government saying that they've got an initiative to actually achieve something. And one of the key things we'll obviously look at straight away is can we get the financing? And the financing will be either very difficult or very easy, depending on its territory and the mix, whether it's established and who all your counterparties are and the usual factors that make up the transaction. So what's happening more and more because of a variety of regional challenges and particularly the increase in the interest rates is that funders and project owners are, in the broader sense, are looking to find ways to help attract in additional and lower cost private capital as part of the structures. So that's when they'll turn and look to the insurance markets sometimes for what they class as an insurance wrapper or some kind of structured insurance solution, and that's where we're approached continuously. If there is something that can be done there, and I'm not talking about just your property and business interruption insurances, your liability insurances, we're talking about proper financial support insurances to protect the investors, to protect the debt, and also in many ways to protect the equity that's going into those structures, which can be done in a variety of ways. So once we're doing that, then we move forward, obviously, into that project and asset creation and implementation. So we've moved from what I think a lot of the structures are that are available in the market, which are prescriptive. They have a very specific area they want to fit, and they don't respond on a bespoke way to support projects. And I think a key part of blending finance underwriting in terms of lenders and investors with the insurance is having a structure that enables you to be much broader and more flexible in your underwriting decisions and the way that you can package a structure to support the capital being deployed. And that's where we then obviously move into that final project stage with the client, not just ourselves, but obviously with other partners who are involved. So the sort of the ecosystem, which we can just go to the next slide. We talk about Matrix as having an ecosystem where we are very unusual in terms of the way that we're organized, because we are set up, say, not to sit just in a silo position, because the criticality factor to executing these transactions is having relationships with all the key stakeholders. And to be able to work and support those organizations in multi dimensions. So as I'm saying here, we're working with project sponsors, private equity funds, the banks, NGOs and governments, and obviously the DFIs and the multilaterals, broader investors, insurance brokers, and insurance and reinsurance companies. And even within that structure, because there is such a misalignment of the way that the reinsurance and the direct insurance markets are currently aligning themselves in terms of deploying these structures. And we've even gone to the next step of setting up our own insurance company specifically to put an underwriting team together to be able to package these transactions to then help bring the other players in who don't have that underwriting capability. And that's particularly focused on three key vertical areas. So non-payment insurance to protect the investors, technology performance, and residual value, which we'll just now go on to talk about. So we're going to go to the next slide, please. So just in terms of these, the products that we're specifically at the very specialist end of the scale concentrating on are ones that are geared to sit alongside the normally an equity and a debt structure, and to enable the mostly the debt to be focused on in terms of being able to provide a level of security for a period of years that could range from anything from 3 to even up to 30 years, depending on what the type of program is that we're putting in place, and range from ones that are very specific to the particular issues that the investors are concerned about, which might be one particular element of the structure, right through to a very broad base of non-payment insurance, which we'll talk about at the bottom. But one of the key ones, if we're talking about infrastructure, energy projects, things like that, is technology performance. George heads up that particular area for us, so I'll let him give you a bit of a summary on that.
Can we have the next slide, please? So every project seems very easy on paper. Every project seems like a brilliant idea on paper. The problem comes down when you start going into the details and the various risks. And we have spoken earlier about various sources of capital having different risk appetites, and the problem of unlocking a lot of government finance is that they require private equity to go alongside with them, who have a different appetite, who look at risks differently. And we address all of these risks separately, and technology performance is one of the key risks. Now, technology performance risk can come in two shapes. One is that the technology is new, untested, and this doesn't have to be a science fiction technology. It can be something that we talk about every day, but nevertheless, somehow that constellation of the technology which is envisaged in a particular project is new, and investors are skeptical, or the EPC contractor is not acceptable to the investors. So TPI, or technology performance insurance, as we call it, is not actually one instrument. It's a combination of several instruments, one of which is there to guarantee that the equipment will produce at least at a certain minimum level once it is handed over, or when it will be handed over. And the other insurance product ensures that the project itself will produce a minimum amount of whatever it is supposed to be producing, which is sufficient to service the debt. And we combine these two products to provide something that people tend to call an EPC wrap, even though that is a very widely used and abused term. So we have done projects across the globe, in America, in the UK, in emerging markets, where we have applied this TPI to projects and de-risked at least the technology risk for investors, and then we moved on to the next risk. But this was a tick in the box.
Okay, great, thanks, George. And this particular coverage area is one of the reasons now that George works for us, because he was leading on developing a project where the investors required the technology performance risk to be insured for a UK project for a large investor, where Matrix placed that cover for them. So he's the proof of the pudding in terms of how it works. So if we go on to residual value insurance, and again, these are all tools that are designed to help the capital be deployed into investments. We were working with a Norwegian shipping company and a private sponsor who needed to acquire ships. They wanted to, for particularly the emerging market areas, also wanted to do adaptations to them to improve them from a green perspective. And they were looking to get various elements of support for the investment structure, and we assisted in that area in terms of both helping package the funding We forward hedged the chartered day rate for them as part of the structure as well, and put in a base level of residual value insurance, which on shipping, particularly at that time, was very, very thin market. And again, it's one of the areas that we're looking to support. But again, you're putting a floor under the value of that asset for a predetermined point in the future. So in all of these areas, it's about giving the investor certain elements of certainty and transferring elements of their risk out of their program to enable them to pass their credit committee, which is always a challenge, but also to be able to utilize that with the investors to give them both additional comfort, but also to, in a number of cases, validate some of the decisions that are being made at the same time. If we go to the next slide. Okay, then we have non-payment insurance, which covers a number of areas. It's quite broad ranging. So you can have non-payment insurance, which is probably most people who purchased it have been involved with, is generally an insurer coming in behind the underwriting team at a bank to provide effectively default cover, generally up to about 50% of the exposure. And generally fairly high-grade corporate lending, not really in the sort of the emerging markets territory. And as you work your way through, then you can use non-payment insurance effectively to harden collateral, to package assets together, which may have a number of moving parts to enable the investors to become involved. So we've been using these in conjunction with the global insurance market to support more complicated transactions. So we've got a project which effectively revolves around the conversion of and the new build of a range of eco hotels. So obviously nice credentials. There's a lot of appetite from the insurance market and the investment market for those types of elements. But the program required various balance sheet support, and insurance was one way to enable us to actually get around that particular challenge. We go to the next slide, please. In terms of sort of international and government-related projects, and all investors, what we're seeing is that there's a big challenge for organizations, both government and foundation-led, who are trying to attract in capital. And we've, because of the way we're structuring what we're doing, we're working to help to enable DFIs to deploy capital more effectively, more easily, because there's a number of structural architectural barriers through these different layers of funding organizations, which can make it slow and difficult for them to deploy and to be able to leverage the capital that they've got. So our role in this is to come in behind what might be our first loss capital. The Foreign and Commonwealth offices are just about to announce a new £3 billion fund for overseas investments, which is intended to be first loss capital, where we'd be working with a large group called Comonix to then help work with the development funders, and then build a structure using the types of tools we're talking about here to then attract in larger amounts of private capital and in the back of those structures. Can we just go to the next slide, please? So there's sort of a range. You know, there'll be some areas where you're looking at a relatively straightforward situation, and then there are the more complicated ones where there's a lot of moving parts. Probably one of our most sophisticated pieces of work we did was related to Sri Lanka, where there was a project to rehabilitate a large sugar plantation so that they didn't have to import 80% of their sugar from South America, and which combined rehabilitating the plantation, a new mill, combined heat and power, and ethanol plant. $400 million project with well-backed sponsors, but even with that, still requiring debt structure to be brought in of $300 million. And the investors wanted to have a non-payment insurance policy to support that. So our sort of first conversation was probably not what they wanted to hear, is that no insurer is going to give you that because it's a CCC rated country. There is no capacity available for that, but you can build a structure. And I think that's the key in this whole space, is that there's a lot of ways to engineer the program, to combine the finance, to bring the insurers in, and to put together a structure that can be made to work. So this involved us with about 18 different teams from Sri Lanka, around the world, with different component parts, where we looked at everything from the water supply, the irrigation systems, the local environment. We built out an insurance program of the conventional, combined with the design, construction, delayed startup, operational. We also helped to hedge the sugar price and the Sri Lankan rupee, because there's a big liquidity issue, particularly at that point. And then created an SPV structure, which was enabled to be capitalized, which ultimately would issue the non-payment insurance. And because of the way the waterfall of exposures operated, it meant that the time and distance from the initiation of the project, the drawdown of the funding, to when that vehicle may have some exposure, it enabled the investor's position to be de-risked very significantly before those policies would actually get to the time where they may needed to have responded. So again, very, very complex program, but it enabled that project to be on the table for execution. Okay, I think if we just go to the final slide, please. I think we're stuck. It's not moving for some reason. Okay. So one of the just quick areas I just wanted to mention as well, on the insurance policies, was the intellectual property insurance. So again, all of these are non-payment insurances. There are, for example, we're working with a Malaysian group at the moment who are deploying banking payment systems for individuals who are living overseas from countries like Vietnam, to help them get their funding back to their families. So we can actually ensure the intellectual value of those technologies, combined with the business plan, and issue a non-dilutive insurance policy, currently up to about $100 million. To enable additional capital to be brought into the projects for 3 to 5 years, which is normally on an accelerated process there. So again, that's where, when you go back to the SDG objectives, you can see that there are lots of individual solutions that are available to be deployed depending on what the particular requirements are. So that's an overview. Hopefully that's been helpful, and I look forward to hearing any of your questions if you have any.
Well, thank you very much. We're going to repeat the poll we did at the beginning, and we do have some people who weren't on the call at the beginning. So again, would you now consider using structured insurance solutions? See whether things have moved. Just give a couple of half a minute for people to vote. And that's great. Thank you so much. We can just see the results. Well, you've moved up in terms of the proportion who would consider using structured insurance solutions, from 70 to 93%. So you've done something persuasive this afternoon. Thank you for that. We do have some questions. I'm going to start off with a question from Gavin Lillywhite, asking just to what degree is the current geopolitical environment and the resultant uncertainty having an impact on investment? And if it is having an impact, can you think of ways that this impact could be overcome?
It's definitely having a very significant impact. I think there's no doubt about that. I think we particularly find with, and I'm not, we have a business in the US and the US people working for us, so we're not saying that they're not supportive, because they clearly are. I think there's a key issue with investors from the US and insurers who are based in the US to participate in supporting projects in the emerging territories. I think there are structural elements that they have challenges with, regulatory challenges as well, which I think are problematic. So again, that's why we spend a lot of time working with them and developing these types of solutions to help them basically be facing a rated piece of insurance paper rather than having to face the underlying project. And I think that's definitely one of the ways to do it. I think the European, Asian, Middle Eastern, and African investment markets obviously have a different view, and also the South American investors as well. So I think there's some structural elements in there. There are also some challenges around areas like political risks cover, which is what most people are commonly familiar with for developing territories. And I think part of the challenge there is to do one with capacity, but also with onboarding, because it's actually very difficult for new buyers of political risk cover to get onboarded currently by quite a number of the insurance markets. So there are things that can be done. Again, that's where rather than tackling how you put the package together just by component, it's really important to link all these things together, because then you're able to address the concerns of the political risk players by bringing in other parts of the program to support it.
Thank you for that. Christopher Gleadle has asked a question, but first of all, thank you for a very interesting presentation. And you mentioned earlier sort of financing a water project or waste to energy or infrastructure. And he says, does it have to be either or silos rather than unified projects that tackle water, energy, infrastructure, and other goals to raise the effectiveness of the whole project?
Yeah, no, absolutely. I think that's a key area that we're trying to encourage, so that they are integrated projects where you're, because in many ways, by doing that, you're creating more of a portfolio approach to the investment as well, because you've got more than one asset. And I think there are sort of two things with the insurance markets, is that any of the insurers, even the ones who are prepared to take a financial risk in there, they're not looking to they're not looking to replace the equity investors. They're looking to align and support them as part of that structure. So they are playing in the equity space, but they don't want to be the only ones to do it. And also, when you're putting these types of structures together, like any investment approach, the more that you can remove the front line from the action and create more of a diversity within that structure, the more likely you are to be able to secure a program for it.
Thank you very much. Gavin Lillywhite has got another question. He's just really interested in how you're addressing the cyber and physical damage risk to assets and the potential reduction on return on investment as a result of damage. And saying a lot of that stuff is typically excluded under standard property asset insurance policies. So how do you manage sort of physical asset damage and cyber risk?
So I guess it depends which type of project we're talking about, what type of investment. Again, that's where the ecosystem approach comes in. Because when we're looking at these, we're approaching everything as if we were investing our own money. So we're looking at all those risks. You're looking at, because nobody buys insurance for the fun of it. They're buying it for a reason, to create an effect. In terms of dealing with these issues, and cyber without went out is one of the big key issues in a lot of the projects, is having teams of organizations specializing in the enterprise risk management aspects to this. And I think that's key to what we're doing here, is that we're integrating all of these components in a very vertical approach of controlling everything from the decisions that are being made right on the ground level all the way through to the top. Some will be managed by process, contract. Others then will obviously be looking to transfer out into the conventional markets, and there is a big market. So that's why you have to have a big team of people who are right at the cutting edge of their capabilities, but also understand the geographic and sector and technology elements to this.
Thank you. And it's Simon on the call. He's asked, do you have a typical customer? How would you define the people who are likely to find their way to your door?
So it's very varied in terms of what we'll get. So we'll have individual development teams who are contacting us because they're building or developed a coal alternative technology. We've had people creating a structure for the production of isotopes for targeted cancer treatment. We have people like our Sri Lankan projects. We have government departments connecting and contacting with us. And we have a big universe of investors and funders that we work with as well. So, for example, I was on a call yesterday with a large asset manager where they were talking, who we'd never spoken with before, and they'd had a couple of scenarios where they'd walked away from assets which now they'd spoken to us they might not have. So one was acquiring an offshore wind farm where there were some yield performance issues related to the equipment and the underlying organizations maintaining them in their balance sheet. So you can't deal with things that are guaranteed to happen because that's not insurance. But what we can do there is to bring in risk management activity alongside them in engineering to help stabilize where they are, and then put in a structure which means that if it then deteriorated beyond a certain predicted point, then the insurance would come back in. So it enables them to look at that strategy in that way. So they come from all directions. And we have obviously the insurance market and insurance brokers coming to us as well. So it's a very much a collaborative space that we sit in.
Thank you. A couple of last questions. I mean, Gavin Lilly wants to come back with a further thought. Just asking whether the recent bad press on green investment returns versus traditional assets, for example, Chevron's investment in Hess, has that bad press impacted investments in support of SDG development?
I mean, there's certainly across the board, and again, it sort of varies country to country, an effect of anti-wokeism, I would say, is one of the issues. And certainly when you see, the CEOs of some of the biggest global funds in the world having their lives threatened because of the statements they're making about the support of green, that there are some challenges in there. But I think, again, ultimately, I mean, oil's the big challenge. Batteries and vehicle production is a challenge because is it achieving the objectives, and can it achieve the objectives in time, and will people still stop using it? So I think there has to be a relatively pragmatic approach. I think in the long term, the investors, what we're seeing, and definitely with the insurers, although I think they're having to slightly moderate the position related to what would be seen as dirty assets, because the reality is that we can't function without them. So I think there's a more nuanced approach required to doing that. And partly that's where when you're applying, and the insurers have such a big role in the projects that we do as well, is that we look to put conditionality on structuring and providing some of the insurance programs to help link back into net zero, carbon targets, and the whole sort of ESG space. I think one of the challenges, and it's a little bit, if I go back to regulations, a bit like when the FCA came in the UK to start with the industry, and they were a completely binary, prescriptive-based approach to their rules and guidelines. And the reality is, it wasn't working. So they moved it to more of a principles-based strategy. And I think to an extent that's where this is having to sit, is that you have to have flexibility in what you're doing, but you've got to have a core goal. Otherwise, I think a number of the measures that people are trying to implement are just too rigid, and then they're not getting the money out the door. And a good example is there's a very large, very rich US guy who set up a delivery business who is giving away $10 billion for investments in sort of changing investments, no return required. And they, when we were talking to them, are about 30% behind where they should be. And it just shows the difficulty in actually aligning capital with projects and bridging some of these gaps. And that's why I think within this mix of what we're trying to do, that's where we play.
Well, thank you very much. I'm afraid time's beaten us, Scott. Thank you so much to you and George. Just to say again, thank you to our sponsors. We really are grateful for the support in running this series of events. Just a brief look at forthcoming events, a lot going on next week. And in particular for me, the launch of the Global Green Finance Index 12 is taking place just on Thursday. Just a final round of thank yous. First of all, thank you all for turning up and for your interest. Thank you so much to Scott and George for a really interesting look at alternative ways of finding the way through the thickets to develop funding structures. It's been great. Thank you very much, and thank you. We'll see you all again shortly. Thanks. Bye-bye.
Thank you.